most people assume that the size of your paycheck is going to determine if you're going to retire with millions of dollars or just a couple $100,000, but that's a lie. The thing that determines how much money you're going to have when you retire is what you do with your paycheck when you get it. And unfortunately, most people, regardless of how much money you make, have no idea of what to do with their paycheck once they get it. And in this video, I'm going to go over the 7 steps that if you do these things with your paycheck in this order, it's going to put you on the path to have millions of dollars when it comes time for you to retire. So let's jump right in. The first thing I want you to do is reduce your automatic costs. And this is something that most people overlook. Because when you make $1,000, all $1,000 don't go into your bank account. What happens is first, the government's going to want to take their share with taxes. And then if you have something like a 401k, some of this money is going to go in there. But this is where I want you to look into both of these things, your taxes, things like your 401k, and see if you can reduce your costs. Because what happens is some of this money goes to taxes, some of this money goes to 401k, and then whatever's left goes to you. And I drew you right here. For my male followers, I drew you a mustache, or as we like to call it in my native language, Punjabi, a much. And for my female followers, a braid, which in Punjabi, we call a gut. So now, what you got to understand here is your taxes on 401k money is automatically being taken out. But the question is, are you getting the most value, and can you keep more of this money for yourself while still getting the same returns? Because most people in America are overpaying on their taxes. And most people in America don't know how much their 401k fees are. How do I know? Well, NerdWallet did a study and they found that 92% of Americans have no clue what their 401k fees are. Now, if you're listening to this video and you're saying, wait, Jaspreet, do all 401ks charge fees? Because I didn't know that I had a fee to pay with my 401k. I hate to be the person that breaks the bad news to you, but yes, every single person who has a 401k, who has money invested in these funds, has fees. So let's go through how to do this, starting with taxes. As an attorney, who's not your attorney, what I can tell you is that our tax code is a rule book, period. And the person that gets the least flexibility is somebody who earns their money through a W-2 income from their job. When you earn money through your investments, when you earn money from your business, you have a little bit more flexibility. Now, that doesn't mean that you have no flexibility when you earn money from an income through your job. But this means now you're going to have to be strategic. Now, of course, I want you to invest your money. Now, of course, if you start a business, that's great. I'm not against these things. But even if you are just a W-2 income, I want you to see and invest some time and maybe a little bit of money to make sure you're not overpaying in taxes. And as you make more money, as you get into the 6 figures of incomes, now it becomes even more worthwhile for you to maybe spend a couple $100s to hire an accountant to review your tax return to make sure you're not overpaying in taxes. So what are some ways that you can do this? Number 1 is making sure that you're maxing out your deductions. And number 2 is potentially starting a side hustle. Because if you start a side hobby, well, now the expenses you use for your side hobby can be a deduction. And if you lose money, this can be used to offset some of your ordinary income from your job. So, for example, let's assume that you like cooking and you want to start an Instagram page or a blog on cooking. And at the same time, you want to do a kitchen remodel. That way, well, you have a nicer kitchen. That way you can also cook some nicer things and talk about it on your blog. So now if you spend $20,000 remodeling your kitchen, this can be a business expense on your business. And if your business doesn't produce at least $20,000 worth of income, that would be a loss for your business. And some of this money could be transferred over to reduce your taxable income from your job. Now, again, I am not a licensed tax advisor, but this is where, when you start getting into these things, it helps tremendously to have a good tax advisor. And for the sake of this video, I'm not going to go too deep into this, but I already made a video where I talked to my accountant on different ways and things that you can do as an employee to reduce your taxable income. And I'll link that video for you down in the description. The second thing I want to talk about is your 401k. Because your 401k, when you invest money into 401k, whether it's a Roth or a traditional, you're putting your money into these funds, which are going to invest your money for you, which is great. But now what you got to understand is these funds that you're putting your money in, are they low cost or high cost? Because what a lot of people would consider low cost might end up actually being high cost. So your homework here is to look up your 401k portfolio and take a look at what your expense ratio is, like you see on the screen. Now you might say, well, Jaspreet, a 0.85% expense ratio doesn't sound like that much. Like if I invest $100, that's less than a $1 fee. Is that really a lot of money? Well, the question is now, if you project that 0.85% expense ratio over the course of 40 years, how much is that going to cost you? And if you invest $1,000 a month for the next 40 years and you can get an average, say 10% return, that 0.85% fee is going to end up costing you more than $1 million out of your investment portfolio. It's going to cost you somewhere between 20 to 25% of your investment portfolio because you're paying less than a 1% fee. This is why it's so important for you to check your fees, because guess what? There are other funds out there that could cost you less than 0.1%, which means you could get similar returns and keep more money in your pocket. Now, the reason why some people like these higher fee funds is because these funds will try to promise higher returns than the lower fee funds. Now, of course, it's not guaranteed, but this is where what you have to understand is, are the higher fees justified through the higher potential returns? And this is where some people like Warren Buffett says, I don't think so. What Warren Buffett says is that you'd be better off with one of the lower cost funds because it's going to keep more money in your pocket. And Warren Buffett even did a $1 million bet. Or what he said is, if you just put your money into a low cost fund and left it there for 10 years, that you would outperform one of these higher cost funds managed by the money managers. And after 10 years, he was right and he won $1 million. So I want you to take a look at your 401k today, see what your fees are, and see if it might be worthwhile to find a fund that could potentially cost you less money in fees so you can keep more money in your pocket, because those little switches could potentially save you hundreds of thousands, if not even millions of dollars, just by making a teeny tiny little switch. Now, moving on to number 2, once the money hits your bank account, after you pay taxes, after you pay for your 401k, the second thing I want you to think about now is, once this money hits your bank account, what do you do with it? And what most people assume, if you want to build wealth, is, I gotta go and invest my money. I gotta go and start buying assets. But hold your horses, because what you got to do is make sure you have laid your foundation. Because it's always one of the most difficult things for me to hear when somebody's talking about, I have $8,000 worth of credit card debt, I have no savings, I want to go and invest in stocks so I can get rich. We got to flip the priorities, and what you got to do is you got to lay your foundation first. And what I mean by laying your foundation is you got to do 2 things. Number 1, if you don't have any savings, the first thing you got to do is you got to save $2,000 in a separate bank account. This is your start to your emergency fund. This is your start to your savings that's going to protect you against emergencies. This is not money you're going to invest. This is not money you can use to buy a watch. This is not money you're going to use for a down payment on a car. This is money you're going to keep there just to protect you against you lose your job. This is there to protect you against something bad happening. So you got to take $2,000, put it here as fast as possible. Once you do that, the second thing I need you to do is you got to work to pay off your credit card debt as fast as possible. Because if you have credit card debt and you're paying 15, 25% a year in interest, it doesn't make sense for you to take this money and go and invest it in the stock market, because guess what? The stock market averages a 10% return. That's what it's had averaged for the last century. So if you're paying 15 to 25% on your credit card debt, why would you want to try to get a 10% return when you could get a guaranteed 15 to 25% return here? This is now part number 2, where you got to lay a foundation, save this $2,000, pay down this credit card debt, which then brings us to number 3. This is where you got to build a financial system. So now what we have is no credit card debt. You have $2,000 saved up in a separate bank account for emergencies. You have this check-ins account where your money goes to. Now you're going to open a third bank account. This is money that you're going to hold for your investments. So what you're going to do is you're going to have a separate bank account here. I'm going to call this I. This is going to be your investment bank account. Not your actual investments here, but the money that you're going to invest. And now you're going to create a financial system where every time you get paid, some money is going to go for your savings, some money is going to go for investments, and then you're going to have some money left over to spend. Notice how I said this, because what most people do is they ignore this. They have money hit their bank account, and this is money that they can spend. You're doing this completely different. You're doing what wealthy people do now, which is where you're going to prioritize building your wealth first. And that means you're going to prioritize your investments and your savings before you go out and spend all of your money. Now, what does this automation look like? Well, one of the things that you can do is follow something as simple as my 75-15-10 plan, which says now, for every dollar that you make, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. That means that every time you make $100, $15 goes here, $10 goes here, and $75 stays here. Now what you're doing is, this money is almost like being spent, but it's being spent on yourself. It's being spent on yourself to have money for your investments. It's being spent on yourself to have money for your savings. And then you have some money left over to actually be spent at other places. Your car, at Gucci, at your food, at your clothes. This is the money that you're going to be able to spend. Now, the reason why this is so difficult is because everybody says, wait, You want me to live off of 75% of what I make? I'm struggling as it is, and I'm spending every dollar that I bring in. How in the world am I going to do this? Well, you got to make that decision. What is more important to you right now? Is it building wealth or is it something else? Because if it is building wealth, you will find a way to fix this. You will find a way to cut back on your expenses. You will find a way to drive a smaller car. You will find a way to live in a less expensive home. You will find a way to save some more money every single month. And you'll also find a way to earn some more money because that's what's important to you. If it's not important to you, you won't. And I know it's difficult. It can be very difficult, especially as you have kids, especially as you have a partner you got to take care of. It can be hard. But this is where you got to prioritize what's important for you. And if building wealth is what's important to you, this is the system. You have to have money to invest. If you don't, you're not going to become wealthy. If you're spending every dollar that you make, you're never going to become wealthy. If you make $50,000 a year, guess what? Between the ages of 25 and 45, you will make $1 million in your career. But most people will have nothing to show for it. And this is where what I want you to do is as you make this money during your career, I want you to have something to show for it. Not just a BMW. I want you to have real wealth to show for it. Now, that wealth can help you buy the BMW, but most people are buying the BMW with their hard-earned money. And then they have no wealth to take care of them. I want you to have the wealth first, and then let the wealth buy your BMW. So this is why now what you got to do is create a system where every time you get paid, some money is going to be invested, some money is going to be saved. I would prefer it if you automated this. Most banks nowadays will let you do this for free, where you can create an automatic withdrawal. So if you have 3 bank accounts with one bank, money hits your bank account right here, and then automatically some money can go here, automatically some money can go here. That way it's separated. That way you don't accidentally spend your investment money or your savings money. Number 4, when it comes to your investments, I do not want you to make any more emotional investment decisions. I want you to make financial investment decisions. This is something that we talk about a lot in Market Briefs and Briefs Media, my company, because unfortunately, it is very easy to get caught up in this whole game of, well, people are talking about this stock online. I want to buy the stock. I want to find the next Nvidia. I want to find the next Tesla. I want to find the next Amazon, and I'm going to throw my money into these companies, and hopefully it's going to skyrocket after I buy it. Or I'm going to find this new cryptocurrency. I'm going to buy it, and somebody's going to talk about it, and it's going to make me a whole lot of money. Once you start doing that, what you'll realize is many times you'll put your money in, and you don't get any money out. That's not what investing is. Investing is a little bit more strategic and a little bit less attractive. Investing is where you're going to put your money into, for most people, they're boring investments. They're boring things. For people that are weirdos like me, it's exciting, but for the average person, it's boring. But that boring is where the real money and wealth is built. And that boring also means that it's going to take time, not 6 months, but years, if not decades, to really see your money grow and make you a lot more money. And this is where you got to do a few things. Number 1 is you got to stop letting emotions get the best of you. Number 2 is you got to come up with a strategy. And then number 3 is you got to execute on that strategy. Now, one of the things that helps here is paying attention to what's happening, but not get caught up in the emotion. That means understanding what's happening and understand the trends of what's happening in the markets. Because your goal now as an investor is to find the next trend in the markets and then invest your money where money is going, not where money has been. Because when you invest your money where money has been, that means you're investing your money into the next Sears, into the next Bed Bath & Beyond. And that's not what you want. You want your money going into the next industry that's going to be able to make you money. Now, this is why we created Market Briefs as an easy way for you to stay up to date on what's happening in the financial news. It's free, it's fun to read. You can read it in less than 5 minutes every morning, and we cut out the emotion that we can understand what's happening in the markets, from the economy to housing to stocks to crypto to the global economy. You can read it in less than 5 minutes every morning, and it's free. So if you'd like to join Market Briefs, I got the link for you down in the description below. But this is where now you got to understand, you want to follow the trends, but then number 2 is you got to have a strategy. And what that means is, how are you going to actually go out and invest your money? Because most people assume now that when I have this money, I got to find the next hot stock. But for the average person, for 98% of America, according to me, you should not be trying to find the next hot stock. Instead, what you should be doing is just passively investing this money into the markets. Just passively invest this money into funds. Index funds, ETFs that will give you broad exposure to the market. Because if you're not interested in trying to keep up with the next hot stock, if you're not interested in listening to earnings calls, if you're not interested to reading financial statements, you shouldn't be trying to find the next great stock to invest in. Instead, it's a lot easier and less risk for you just to invest your money into funds. And so this is where I want you to think about the strategies, what it is that you want to invest in, and what your goals are. Because you can invest in stocks, you can invest in real estate, you can invest in your own business, you can invest for cash flow, you can invest for growth, and you can invest in retirement accounts, you can invest in non-retirement accounts. So there's a lot of things to do here. I don't have the time to do the whole financial analysis of the different ways that you can invest your money, but just understand you got to have a strategy, you got to take out the emotion, and then you got to execute on the strategy. Now, if you do want more resources and education on how to build a strategy, I will link a video where I explain how to do that down in the description as well. Which brings me to number 5, which is understanding your savings, because most people look at savings the wrong way. I grew up in a traditional Indian house. In the traditional Indian house, the idea of wealth was having a big bank account. There was no concept of investing because that's too risky. The idea of building wealth was you make a big salary because you become a doctor, you become an engineer, and then when you make a big salary, you spend nothing. You make $200,000 a year, you spend $35,000 a year, and then you take all the other dollars that you don't spend and you put it in a bank account and you let it sit there. That was considered wealthy for pretty much everybody, the traditional Indians, especially when you come from an immigrant family. But the problem with that is, well, inflation, because inflation eats away at the value of our savings. We've seen this happen really extensively in the last few years after the pandemic, but it's been happening since way before the pandemic. And this is where, if you really want to become wealthy, you can't get there by saving. Now, yes, saving is better than you spending all of your money, but this is where I want you to be more strategic with your savings. And when you're saving your money, I want you to understand that there are 3 reasons to save your money. Number 1, save money for an emergency. Number 2, save money to make a purchase. Or number 3, save money to make an investment. If you're not saving your money for one of these 3 reasons and you're just saving your money to save it, you're saving money the wrong way. Now, how much money should you save for an emergency? What I say is somewhere between 3 to 12 months worth of expenses, depending on who you are and where you are. If you're 23 years old, you're fresh out of college, you're not married, you got no kids, you got no financial responsibilities, you can be more risky. You don't need 12 months of savings put aside in your bank account. Maybe 3 months are fine. Now, when you're 45, you got kids, you got a wife, you got a husband, you got expenses, you got liabilities. Now you might need 6 months. Maybe 9 months. If you have a very low risk tolerance and you can't breathe at night if you don't have a big savings account, maybe you go to 12 months. But once you hit that savings goal, you don't need to keep saving money just to save it. Now you can save money to have it be invested later. Maybe you're saving money for a big real estate investment. Maybe you're saving money because you're waiting for a good opportunity in the markets. That's fine. But it's not sitting there saving just because you think that's what's going to make you rich. And so this is where I want you to understand your savings and be strategic with it. And I want you to have a separate bank account for your emergency savings and then a separate bank account for your other savings. I know sometimes it can feel weird to have all these bank accounts, but it is so much easier when your finances are organized, almost like folders on a desktop, where now your money is organized and you know what this money is for. That way you don't accidentally spend the wrong money. The 6th thing I want you to do when you get paid is I want you to make a spending budget, which means now we're talking about this section right here. This is the money that's left over in your checkings account that's ready to be spent. I want you to have a system on how much money you can actually spend here. Notice, we're systemizing things. We systemize how you invest your money with your strategy. We're systemizing how you save money. Now we're systemizing how you spend money. When you do this with your money, you're going to live a completely different life. And in 6 months, you're going to start to feel very different about your money. You're going to feel a lot more confident about the way your money is going. And in 6 years, you are not going to recognize yourself. You're going to completely forget that old life you had where you had no idea what was happening with your money. It is hard. The first 6 months are hard because you're going to completely change what you do with your money because this is not normal. This is what weirdos do. But if you want to become wealthy, you got to be a little weird because you can't keep doing what the majority of people do because the majority of people are broke, the majority of people are unhappy, and the majority of people are unfulfilled. And I want you to live a completely different life. So let's talk about now, what does it mean to spend within a budget? Because now what ends up happening is you might have, let's say, $2,000 sitting in your checkings account. And now you're walking down the street and you see this amazing sale on a brand new 85-inch TV. And guess what? It costs $1,995. And it's on sale because it used to normally cost $3,000. And now you say, well, I got $2,000. Let me go buy this TV. But this is where you got to understand the difference between being able to buy something and being able to afford something. But before I answer that, let me give you one more example based on the same situation. You're walking on the street, you got $2,000 in your bank account, and you see this 85-inch TV over there, and it's listed on sale for $3,000, and you have $2,000 in your bank account. And the salesperson says, all you got to do is put $200 down, and then they'll finance the other amount of the TV at 0% APR. Again, to the average person here, they can afford this. They feel like they can afford it because they can make the monthly payment. But I want you to think about affording completely different. Number one, affording means you buy it with cash. Affording does not mean that you're going to finance it, even if it's with 0% APR. Number two, just because you can buy it with cash doesn't mean you can actually afford it if it is a luxury purchase. And this is where it takes even more financial discipline, which is just because you have money in your bank account doesn't mean you can spend all of it, because then you're going to have no money left over to do other things. And this is where what you got to do now is understand a couple things. This is the money that you can use to eat, and this is the money you're going to use to live. Now, that being said, if you have this money left over, is it okay to spend? And what I like to do is be a little strict on myself, because I want to be more aggressive with my investments. I want to be more aggressive here. That way I always live within my means. So when it's a luxury, something that I don't need to survive, I follow a rule of 5, which says if I can't buy 5 of them, I can't afford 1 of them. And that's hard, because that means if I want a $2,000 TV, I better be worth at least $10,000 and be able to buy that with cash if I want to be able to afford it. Now that's hard, and I get it. That's going to make a lot of people very angry, but you got to decide, what are you prioritizing? And now when you're going out and spending money, the 2 things you have to remember here are, number 1, you're not going into debt to buy things that aren't making you any money. The only exception here is your home. And number 2 is when you go out and buy something, you're not spending all of your money to buy it. Because now what that's going to allow you to do is keep more money for yourself. That way you continue to have more money to invest, save, and build your wealth. And that we have cash to fall back on. And this brings me to point number 7, which is often overlooked. So now what we did is we talked about how you save your money strategically. We talked about how you invest your money strategically. We talked about how you spend your money strategically. But there's one part to this that we haven't talked about, which is your earnings potential. And one thing that I want you to think about is how you can work to increase how much money you make. And there's a lot of ways to do this. This could be, if you're working a job, figuring out how you can make yourself more valuable so you can make more money, so you can get a raise, so you can work to increase how much money you're bringing into the system. Maybe that means you got to get a career change or do something different. Our sponsor, CourseCareers, has a bunch of awesome courses that you can take that will give you certificates to get a new career and make a whole lot more money. You can even get a free course. I got their link down in the description. But this is where you got to understand that if you want to be able to get to this wealth faster, you got to be able to put more money into the system. What most people assume is if I make more money, I'm just going to become more wealthy. Because if I make more money, I can buy a nicer car. If I make more money, I can buy a bigger home. If I make more money, I can go on nicer vacations. But what you're doing is you're making more money to spend all of your money. But now, because you understand how to save, you understand how to invest, you understand how to spend, this is where now earning your money has the most potential and the most power, because you're earning money for a completely different reason. You're earning money for a completely different purpose. You're earning more money to fuel your financial system. You're earning more money, that way you have more money to invest. You're earning more money so you have more money to save, and then you also have a little bit more money to spend as well. But this is where you got to have the strategy in the first place. And now, normally, I would end this video because I talked about the 7 things that you need to do when you get paid, but I'm going to add a little bonus here, because one thing I also want you to think about is as you make money and as you build wealth, how can you give as well? Now, everything we talked about are things that you need to be doing with your paycheck. When you get paid, I want you to think about how can you keep some more of the money for yourself so you don't give all your money to taxes and your 401k fees. The second thing is, how do you lay your foundation? How do you build your first little bit of savings? How do you pay down your high interest credit card debts? Then the third thing is, how do you build your financial system? The fourth thing is, how do you invest your money? The fifth thing is, how do you save your money? The sixth thing is, how do you spend your money? The seventh thing is, how do you earn more money? Now, the eighth thing that I also want you to think about, especially as you're building your wealth, is how do you give back? In my culture, my religion, the Sikh religion, S-I-K-H, yes, it's pronounced Sikh, not Sikh, there's a fundamental tenet, a concept called seva, which means selfless service. Now, regardless of what religion, what practice, what culture you're from, I want you to think about how you can give back and support your community. Because the wealthier you become, the more you can do, the more you can give. And for some, that might mean giving money. For others, that might mean giving time. And as you start to build your wealth, because what will happen is if you did not grow up with financial education, once you start doing this, in 2 years, you're going to be a completely different person. You're going to live a completely different life. Now, you can help a lot of people, not just because you have more money, but because you also have more knowledge. See, we didn't grow up with this financial education in school, so at least most of us didn't. And so this is where now it really becomes important for us to help spread this financial education, because the people that end up becoming wealthy in the system are the people that understand how to do it. It's not just having the hard work ethic. I mean, a lot of people work hard. The problem is most people just don't know what to do. And so you're working hard in the wrong direction. And so as you start to build your wealth, I also want you to think about now how you can give back. And it doesn't just have to be money. Yes, that can help, but also how you can also give back and help spread the education, because that can help build a lot of people's wealth, because they'll understand what to do, what you did. 2 different types of statements that you want to look at. 10Ks and 10Qs. 10Qs are your quarterly financial statements. Your 10Ks are your annual financial statements. What you want to look for are 3 different things: the balance sheet, the income statement, and the cash flow statement. These are the 3 main financial statements that every publicly traded company, every stock in the stock market has to publish.